quick funny story. My grandmother, she knows I do taxes. She called me a couple of years back, and she's like, "Hey, Sean, you're going to do my taxes this year. Oh, yeah, by the way, I sold my property. I have the money in my account. I'm going to buy another property and 1031 it." I'm like, "Grandpa," I'm like, "that does not work like that." I'm like, "You're done." Like at that point, it was it. She touched the money. There was no way around it. She lost all, chances to 1031 it. So if you are thinking about doing it, talk with your CPAs and accountants early on, talk with an intermediary, start that conversation as soon as possible to get that stuff in the works to make sure that you do not miss it or do not mess up so you can avoid those capital gain taxes on the sale of a property.
Hello, and welcome to the Succeed REI podcast and YouTube show. I am your host, Vitaly Volpov, and I have an awesome show lined up for you guys today. Today, we're going to dive into something that most people probably don't find too exciting, but it is something that is essential for success for entrepreneurs and real estate investors, and that is tax planning. My guest today is a CPA who's also a very active real estate investor with over 40 rental units of his own, and he's also a real estate agent at the brokerage that I own with my business partner. And he drops some serious knowledge about all kinds of tax planning and tax strategy topics, specifically from the perspective of a landlord and a real estate investor. We talk for over an hour and go pretty in depth on everything from types of deductions real estate investors can get, to differences in capital gains tax rates, to depreciation, to cash out refis, tax advantages of house hacking, best practices for records keeping, and so much more. Even if you already have a solid understanding of taxes, I promise you, you will still have a lot to learn and a lot to take away from this podcast. So without further ado, let's jump into the episode. All right, Sean, welcome to the podcast. And why don't you tell everyone a little bit about yourself, your background, and your connection to real estate?
Awesome. Thanks, Vitaly, for having me on today. Exciting topic we got, talking about some CPA and some tax stuff. Hopefully this conversation can kind of help out some investors. So my name is Sean Daley. I am a local real estate investor in the upstate New York area. I went to a local college here in upstate New York area right after high school. I knew I was going to pursue an accounting degree. Reason being is because I knew that I could take accounting into any direction, right? Whether you're a pizza shop owner, whether you're a real estate investor, or whether you own, any business, from whatever the case may be, everybody needs an accountant and you need a good accountant. So that's kind of what steered me in that direction. After college, I pursued my MBA, where I ended up getting my CPA license. And then after that, back in probably like early 2018, I bought my first duplex, which is a house hack. I currently live in that residence to this date, live in one side, rent the other, which has been an awesome experience so far. And it really kicked off my real estate career. So from there, I ended up buying a 4-family property, which we can kind of dive into a little bit more as well. And then after that, I ended up partnering up with another local gentleman here in the upstate New York area. Kind of worked with some mentors on some BRRRR deals and how to really grow and, really scale up your real estate portfolio. And from there, essentially, we've been able to purchase like 35, 40 units since then, and really just kind of, grow our portfolio. So me having the tax background has been able to really enable me to help the accounting side, the tax side, understanding the tax code, especially when it comes to real estate investing. And here we are today.
Awesome, man. Yeah, there's so much there. I love it. I absolutely love it. And I think, as you know, obviously, about myself and other investors that are in our circle, so many people have started with a house hack where they were living in the rental property, renting out the other side or the other unit. And it's worked out so well for so many different people. And we've done this. I've done this on my YouTube channel and on the podcast before. We kind of covered exactly what house hacking is. So we won't belabor it too much, but I just want you maybe to define that for a second and also talk about how that has enabled you to be successful as a real estate investor and get into real estate? And also maybe touch a little bit on the tax aspect of it, because I know there are some particular tax advantages or uniqueness when you are living in part of the property and you're renting out the other part.
Yeah, absolutely. So we bought our first house hack in 2018. When I was renting at the time, I was still in college. I had basically told myself, why buy a single family house when I can buy a multifamily house, live in one unit, and essentially have the tenant, pay the mortgage, offset the mortgage, whatever have you. So we basically found a house here in a little suburb outside of the Albany area, moved into the house. And funny story. So I moved the tenant in probably 2 or 3 months after we had purchased the property because the tenant side was vacant. And I want to say maybe like a couple of weeks went by. I took a trip down to Florida to visit some of my family down there. And I remember just like waking up one morning and I remember like looking at my bank account and seeing that the rent was paid. And I was like, wow, I'm in Florida. I didn't do anything this month regarding the rental property. And I got paid, the rent. And I'm like, the light bulb went off for me at that point. I'm like, why am I not doing this, more often? And that really like kind of kickstarted me into, okay, I need to essentially buy more real estate. So the big thing about house hacking that I have learned, especially being a tax professional, is the substantial amount of tax write-offs that you can get owning and living in a rental property. So when you live in a rental property and you are occupying one unit and you have the other unit rented out. So for example, any single property, whether it's a single family house or whatever the case may be, you have expenses associated with that property. Insurance, taxes, mortgage interest, repairs, maintenance, water, sewer bills, utilities, whatever the case may be. Now that you're living in a rental property, you can take those expenses that you normally would not be able to write off if it was a single family house and offset those things against the rental income that you're getting. So in theory, you really are kind of claiming income almost tax-free in a sense, because whether you lived in a single family house or you lived in a duplex and you rented out the other side, that you're living in, you're going to have those expenses regardless. You're going to have to pay for the insurance. You're going to have to pay for the taxes. You're going to have to pay for interest. So now that you're able to use those expenses regardless to offset the income you're getting, you can ultimately, have essentially like almost tax-free income or, tax-free rental property income, on the property. And we'll dive a little bit more into that as we kind of go through the slides and stuff like that. But to this date, I have not paid a single dollar in tax on that rental property income that I have generated from my duplex that I live in today. And a little side note too is, a lot of the things that you do at your property, if I had to buy a shovel, if I have to buy salt during the winter, if I have to mow the lawn, all of those things that you'd be doing as a regular property owner, as a single family property owner, you can write those things off against that income as well too. So not just like the major expenses, a lot of like the minor expenses as well too, which can really offset, you're almost getting rental income for free and not paying any taxes on it. So,
right. Let me ask you this. So let's say that your rental income gross for the year was $10,000, right?
Okay.
And your combined deductible expenses that you just listed add up to more than that. Let's say it's $13,000. Yep. Is there, and you work a regular W-2 job, is there a way to take that additional $3,000 and take it off your regular W-2 income? Is that possible?
Yes. Yep. So there are some rules and some stipulations behind it. I actually do have that in one of the slides, what we'll talk about here momentarily, which kind of goes into the real estate professional status. And if you actually don't qualify for that status, then if you make under a certain threshold, you could still use those losses to offset your W-2 income, your a Schedule C income, whatever the case may be. So yeah, you are able to use those losses to offset some of that stuff, which is, massive tax benefits, in the long term.
Okay. So you mentioned that you have the duplex. You started off after the duplex, I think you mentioned you bought a 4-unit property. Tell me a little bit about that.
Yep.
What was that deal like? And did you do that by yourself, or was that already with a business partner?
Yep. So that was by myself, with my wife and I, girlfriend at the time, now wife. So when we had rented, before we bought our duplex, I can't remember the exact number. I want to say our rent was like $1,500 a month. When we had bought our duplex, we basically saved up everything we had. We bought it traditionally, put down as much money as we can, 15, 20%. And then at that point, I want to say our mortgage was like, maybe $100, maybe $200 more than what we were paying in rent. So I really looked at myself financially and I said, okay, I have a decent paying job. We work, we have, good income coming in. I don't really need the rental income to use to offset anything. I really just treated my traditional mortgage as like if I was still paying rent in that case. So really what I did was, for a full year, is I took that rental income that I was getting, I just stuck it in a separate bank account. Within a year and a half, I had $15,000, $20,000. And I was like, okay, now I have the money for that. Essentially, I took that money and I put that down as another deposit on the 4-family, which is in the same area that I currently live in. And, we bought that traditionally. So there was no BRRRR method or anything like that, but it was a great stepping stone, that really worked really well for us. I did all of the work myself on it at the time, from fixing it up to renovating it, a lot of long nights, things like that, but really learned a lot and really helped me kind of grow my network, grow my, experience, my knowledge, and all of that stuff, in the real estate investing game. And then at that point we had a total of, 6 units, obviously us occupying one of the units, but yeah.
And in terms of timing between the time you bought your duplex in 2018 and the time you bought your 4-unit, how much time passed between those two purchases?
Yeah, that's a great question. So that was about a year and a half after we bought the first one. And partially of the reason is because when you're buying real estate traditionally and you have to put down a down payment, it takes time to save up that money and to put that down payment towards the property. We didn't have at the time, enough liquid cash to be able to just continue to put all these down payments down. So I had to save. In this case, we were saving the rental property income to be able to put that money down. After that, that's when we kind of got into the BRRRR method, partnered up with another local gentleman here in the area. And, essentially we've been able to scale that portfolio significantly using that BRRRR method.
Okay. And when did you start using the BRRRR method? What year was that?
August of 2020. So 2018, bought the duplex. Early 2020, bought the 4-family traditionally. And then about, 6-7 months later, we bought the first BRRRR property.
That's great. And how old are you, just so that people understand kind of the context?
29 years old.
Awesome. Yeah. So, I think that's definitely a path that a lot of people in your position would like to take if possible. But I feel like a lot of people don't maybe know enough about it, or maybe are a little too afraid to just dive in and jump into it. Do you have any kind of thoughts or advice for people that are on the fence thinking about getting into real estate, maybe pursuing either house hacking or the BRRRR strategy?
Yeah, the biggest thing is really education and networking. I went through all of the podcasts, listened to every single podcast on, Bigger Pockets. I remember after I bought the duplex, mowing my lawn in the backyard, put my headphones in and literally just listen to a podcast. It would take me an hour to mow my lawn. And I remember just listening to a podcast, just picking up on like cues and different ways of how people are investing and, ways to generate the money and work through the rental properties and all of that stuff. And then, on the flip side of that is just, talking to people and actually getting your name out there. And honestly, I wouldn't be where I am today if I didn't put my name out there. And actually, funny story, and you might have actually spoke with the other guy on here, Giovanni, who's my partner. But I met him through Craigslist, and after we bought the 2 families, the two properties traditionally, I said to myself, this is great. I love it. It's working well, but it's taking me a lot of time to save up this money. I said, there's got to be a quicker way for me to find deals and be able to do this. Then I started, obviously researching the BRRRR strategy, all of this other stuff about like, okay, how can I scale quickly? I remember sitting in my kitchen, making myself dinner. I had a podcast going on in the background, and it talked about ways to find more deals. I needed to be able to analyze more rental properties than just the ones that are hitting the market on the MLS and be able to purchase these properties. How am I going to be able to find deals? One of the comments on there was like, hey, go to Craigslist. So sure enough, right after I was done making dinner, I hopped right on Craigslist. I found a couple properties on there, dialed the phone number, boom, sure enough, it was today my business partner. And, basically I was getting myself out there. I was building, a relationship. I was trying to put myself in the best opportunity to be able to scale, be able to grow, and be able to get into the real estate game. So
that's awesome. So just so that people know and understand, when we say BRRRR, it's an abbreviation. We're talking about the buy, rehab, rent, and refinance and repeat strategy, where you essentially purchase a property that is in some kind of distress. You need to put in some money into it or increase the rents or improve it in some way to improve its overall financial standing, and then re-rent it. So put in new tenants or, as I said, increase rents on the existing tenants, and then go to a commercial lender or another lender and refinance the property, and then presumably be able to do it again because you're pulling the money back out of the property or reusing the original private investor funds to buy the next property. And that allows you to scale it even faster than you otherwise would if you were just using traditional 20 or 25% down financing.
Exactly.
Cool.
Yep.
All right, Sean. So why don't we get into our main segment of the show, where I really want to tap into your CPA expertise, have you talk a little bit or maybe a lot about various tax saving strategies and tax strategies involved with real estate investing, specifically for real estate investors. Why don't we do that in our In the Lab segment? All right, so I'm here talking with Sean Daley, who's a CPA and a local real estate investor in my area. And I want Sean to get into some of the details that are involved with tax strategies, saving taxes for real estate investors specifically. So Sean, I think we have a presentation that you were going to share with us today. Obviously, if you guys are listening to this on audio only, we'll dive into some of these topics and discuss them. So you don't necessarily need to see the slides themselves, but I think it's helpful for anyone who's watching this to follow along with those as well.
All right, great. Thanks, Vitaly. So first and foremost, I just kind of want to make it clear that, this is my personal experience on real estate and taxes. Please advise your own personal CPAs. Every single CPA is going to give you a different answer. They're going to have a different way about going about things. And it's going to be different across the board, across the state. There's different regulations across the board. So, this is very general topics on a lot of key points that I think will be very helpful for a lot of real estate investors. But make sure you're talking with your accountants, your CPAs, your attorneys, and so on and so forth. So here's the investor's guide into the tax world. Put this, very small PowerPoint together here to kind of help us out and, bring some good tax advice to real estate investors. So who cares about taxes? Well, unfortunately, everybody has to deal with taxes. When we're talking about real estate, whether you're an investor yourself, if you were just a traditional buyer, if you are a seller, if you are a business owner, and essentially every United States citizen, if you are generating income and you own real estate, you will have to worry about taxes. I always like the quote from Benjamin Franklin, in this world, nothing can be certain except death and taxes, because that's very true.
Amen.
So I wanted to kind of touch base on this first. So the power of real estate investing. So when it comes to taxes, there are multiple different streams of income that get taxed differently. So whether you are generating active income, most of the time, most of the people in the world are generating active income. This would be like a W-2. This would be maybe your own business if you own like a dentist office, a pizza shop, so on and so forth. That essentially would be active income. The second one is passive income, which most of the time is going to be real estate driven, but you can also be a passive owner in other investments as well, where you'll end up getting a K1 and reporting that on your return. Another one here is basically capital gains, and that would be you selling an asset that you've held for greater than 1 year. In this case, when we're talking about real estate, it would essentially be a building. So what's the difference between these three sources of income? Well, active income is subject to self-employment tax. What does that mean? If you look on your W-2, you'll see that you pay taxes to Medicare and Social Security. Now, as an employee and a W-2, you have to pay your portion, which is about 7.65%. The employer who is hiring you is paying the other 7.5%. So as a W-2 employee, you have to pay that active income. Now, if you are a person who has a Schedule C, which if you were maybe, running your own lawn care business, right? And you are generating income from mowing lawns and you have expenses and you have a profit. Now you are the owner, basically making you self-employed. Now the IRS says, well, since you're self-employed, you need to pay both the employee and the employer side of those taxes. So now not only are you paying the 7 and 6.5% that you're paying on a W-2, but now you got to pay the full 15% because you're both sides of it. Now, how does that impact real estate investing? Well, if you are a flipper, somebody who is essentially flipping houses, or if you are a real estate agent, or if you are a broker, or if you're like a wholesaler in this case, all of those things fall under active income. It's income generated from the business. It's not considered passive, and you would be subject to self-employment tax. Most of my clients that I deal with who are flippers, I see get hammered in taxes every single year because they made $1 million, but that's all subject to self-employment tax. So they have to pay that additional 15%, 15.3% in taxes every single time you sell a building for a profit. Now, what is passive income? So passive income would be essentially a rental property that you are generating income from renting out the property. The good thing about that is that was not subject to self-employment tax. So you do not need to pay Social Security, you do not need to pay Medicare on that income that you derive. If you have a rental property, it generates $10,000 a year. The only taxes you are going to pay would be the federal rate, whatever your federal rate is, plus the state if you have to pay state taxes. There's no other self-employment tax. There's nothing else. So that's really like one major component of real estate investing is being able to not be subject to that self-employment tax on that income. And then lastly is the capital gains. So if you sell a property and you had it for longer than 1 year, they fix the rate at what that investment is. They fix the tax rate. It's either 15 or 20%, depending on how much total income on your tax return is. Once you get over a certain threshold, it jumps up to 20. But that's a fixed flat rate. So typically those capital gain rates are more as an advantage versus the active income, which your active income could be 25, 28, 30%, 32% in taxes. One other piece of this too, if you have a property and you are flipping it, the IRS assumes if you are a flipper, you're basically like someone who has inventory and you're basically like selling, you're like wholesaling, for example, like a soda, right? You go into the store is going to buy a Pepsi bottle for $1. Okay. They're going to sell it to you for $2. Well, that's $1 in income that they're going to be profiting on. They look at flipping the exact same way. They take a house, you bought it for $100,000, you sell it for $200,000. That's $100,000 in taxable income. If you sell it for less than a year, then if you sell it within 1 year, then capital gains is out the door. You're stuck at your active income rate, which obviously could be much more. So.
And Sean, I just want to chime in on this specific topic as well.
Sure.
And not so much as it relates necessarily to like the tax capital gains part of it, obviously, as you explained it very well. But when it comes to strategy as a real estate investor, it also depends on the market that you're in and what inventory, what real estate is available to you. But when we do some of our flips, and we've done different, both multifamily flips and single family flips. If you're doing a single family flip, your exit strategy pretty much is just to resell the property, because most of the time, most single family homes are not going to be good cash flowing rental properties. So you don't have any other way to offload that property and recoup some of your money or hopefully make a profit. Correct. Other than to sell that property. Right. Whereas my business partner and I and myself, I've purchased small multifamily properties a lot of times, or sometimes with the intent that I'm not going to hold them for very long. I will resell them and improve them and do everything that you normally would do with a single family flip. But because it's a rental property already, and as long as you're doing your numbers ahead of time before you buy it, you can actually give yourself another exit strategy where maybe you do decide to hold on to it, or maybe you have to hold on to it because of market conditions for more than a year. And then when you do end up selling it after a year or 2 years and you make that profit, hopefully, you're not taxed as it's not active income. You actually tax more on the long-term capital gains, which is what you were talking about. So I think it's something I've referred to. I don't know if anyone else calls it this, but I've called it slow flipping, where the intent is to resell it within a certain amount of time, but not less than a year. And you may hold on to it for over a year, put a tenant in it or tenants, rent it out for a while, and then resell it. And you can save yourself quite a bit of money on taxes because you're treating that sale, the IRS is treating that sale as long-term capital gains, as opposed to essentially just short-term or churning your inventory as an active wholesaler or flipper would be. Yeah. So would you agree with that? And what are your thoughts on that specifically?
Yeah, no, I would agree 100%. And I've been in that situation too. You know, we ended up buying a 2-family house that we said, hey, you know, we're really just going to be putting this thing back out on the market, you know, after we fix it up within 2-3 months. And at that point, we were like, you know what, why don't we just hold on to it? The cash flow is actually pretty decent on it. When we kind of ran the numbers, we can refinance out as another exit strategy, just like you mentioned. And essentially now we're not subject to any taxes because now we're past 1 year. So, hey, if we want to sell it now, we're not going to be subject to that active income, rate. The one caveat I will just touch on briefly is the depreciation recapture. So what does that mean? So when you buy a building and the IRS says, well, this building has a useful life. For residential real estate, it's like 27 and a half years. So basically, they take that building and they divide it, the purchase price divided over 27 and a half years. That's the amount of depreciation that you get to write off every single year. So when you do go to sell that property in the future, that depreciation that you have taken for all of those years gets brought back to the table the year of the sale. And you have to pay taxes on that depreciation. So if you take in $10,000 in depreciation over 5 years, well, you're going to be subject to pay taxes on that $10,000, which is going to be subject to pretty much the ordinary income tax rates, which is going to be a little bit higher. And then the difference is obviously, your capital gains, which is the purchase price versus the sale of it as well. Right. So depreciation recapture is definitely something to think about because that's where a lot of people don't really see they don't realize that that's where a bulk of the taxable income is coming from when you sell a rental property that you've held for 25, 30 years. If you've depreciated the entire thing, well, most of that's probably going to be subject to ordinary income, rates at the time. So,
right. Exactly. Yep. So let's continue with some of these other strategies that you were getting into.
Yeah. So the next slide here is basically, so I kind of just wanted to lay out some advantages and key points through basically real estate investing. Some things that, I have done personally, some things I've worked with some clients on as well. And, really trying to, kind of broaden your scope of all of the different avenues that real estate investing can really save you taxes as, a U.S. citizen. So Couple of the bullet points here we'll go through, and then, let me know if you have any questions about anything. So capital gain tax, we briefly touched base on that. One thing I will note in here is if you are selling a property, it's a single family house and it's your own personal residence, and you have lived there for 2 of the last 5 years, up to $250,000 of that gain is not taxable. If you're single, it's $500,000 if you're married. Okay. And now people say, well, I'm selling my house for $300,000. I have to pay $50,000 in taxes. I'm like, no, it's from what you purchased it for, plus technically any improvements that you made, maybe some closing costs, minus what you had sold it for. So if you bought it for $200,000 and you sold it for $300,000 and it was your primary residence, that's a $100,000 gain, and you're a single payer tax filer, then you would not be subject to taxes on that property. So what is depreciation? We kind of briefly touch base on that. Basically taking the building, depreciating it over 27 and a half years. One thing I do want to touch on is, as you are doing improvements to these properties, if anything is going to add value and or useful life to the property, then technically these items need to be added to your depreciation schedule and basically depreciated over the life of whatever that value is that you're adding. So for example, if you replace a roof, the roof costs you $10,000. You can't just turn around and say, okay, I'm going to write the whole roof off. No, the IRS says, well, that's going to last you 15 years, 20 years, 27 and a half years. And you have to be able to add that as an improvement to your schedule. And then you depreciate that over the life of the roof. And you get that expense every single year. Depreciation recapture, we kind of briefly talked about that. And then cost segregation. So what is cost segregation? I've been getting this a lot. So basically, cost segregation is when you hire an outside party. It would need to be an independent outside party to basically come in and break down the entire property that you have into different categories of 5-year items, 7-year items, 15-year items, 20-year items. So what does that mean? Well, if we buy a fridge, if you buy a rental property, right, and you bought it for $100,000, you're taking $100,000, dividing it by 27 and a half years. What cost segregation does is says, okay, you bought it for $100,000, but it's really made up of all of these other small items in here. Maybe a fridge that's worth $1,000. The components to the HVAC system is worth $5,000. The other appliances are worth $3,000. And you break out all of those small items. Each of those items are not going to last you 27 and a half years. A fridge has to be replaced every 5 to 7 years. So now you depreciate that fridge for 5 years. You depreciate your HVAC system for maybe 10 years. And you do that for every single item in the property, which essentially will accelerate a lot of that depreciation rather than just dragging it out over the 27 and a half years. Mm-hmm. There is a cost involved. Typically, speaking with other people who have done it in the past, speaking with some clients, just kind of based on my expertise, I've seen it done at a level where it needs to be usually a larger multifamily, maybe like a 20 or a 30 unit building. And the cost effective has to be, for you, cost effective as well too. It typically costs, $4,000, $5,000, $6,000 to get this study done. So does that outweigh the cost of the taxes that you're going to save down the road? Again, talk with your CPAs, talk with your accountants, start these discussions, because, hey, down the road, it might make sense for you to do that study.
Who are these third parties? Like, are these other CPA firms? Are they specialized?
Yeah, they specialize. Yeah, they specialize in like the cost segregation field. Because you have to, technically, the IRS says you have to have like a report done. I can't remember like the exact terminology of it, but you have to have like an exact cost segregation report done in order to use those benefits of it. You and I just can't talk and be like, oh yeah, I walked through the property. Here's a napkin of what my things were and how much they were going to last me, and then this is what I'm going to depreciate. Technically, that wouldn't be the right way to do it in the eyes of the IRS.
Gotcha.
So bonus depreciation. So bonus depreciation basically allows you to expense the entire item of whatever your improvement is for that year. There are stipulations on that. Again, work with your accountant on improvements that you have done on your rental properties to see if they would qualify for bonus. There are a lot of rules and regulations to what you can and can't do with that. We could get into the nitty and gritty of it, but ultimately, I think it's just very important to know that there's an opportunity out there for you to expense the entire cost of whatever that improvement was or whatever that piece of equipment was in 1 year, which might help some tax benefits that specific year. Again, remember, if you depreciate the full thing that year and you go to sell it next year, that whole depreciation that you had taken is going to be subject to that depreciation recapture. Tax on flips. So we touched on this briefly, but when you're flipping a house, the IRS looks at it as inventory, and essentially you are going to get hit with self-employment tax, active income, and you're essentially going to get hammered in that aspect. So flipping is great income. It's a way to build active income quickly. For the long term of it, it kind of makes it challenging because you always have to look for the next flip to essentially help offset some of those tax, obligations and also continue to generate that income. 1031 exchanges. So a 1031 exchange is basically selling one investment property to buy another investment property. And by doing that, you ultimately avoid paying any taxes on the sale of that property that you sold this year. Now, you are not avoiding them completely. You are just deferring them down the road. So when you do ultimately end up selling that building, that's when you would, when you did not 1031 it, that's when you would be subject to the capital gain tax on that building. The big piece here that I cannot stress enough is really to work with an intermediary to set up the 1031 exchange and to make sure everything's done correctly. There are very strict, very, very specific rules and regulations when it comes to doing a 1031 exchange. So intermediaries are basically, you have to get a special license to be able to do it. They hold the money in escrow for you. You can never touch the tax. Quick funny story. My grandmother, she knows I do taxes. She called me a couple of years back. And she's like, "Hey, Sean, you're going to do my taxes this year. Oh, yeah, by the way, I sold my property. I have the money in my account. I'm going to buy another property and 1031 it." I'm like, "Grandpa," that does not work like that. I'm like, "You're done." At that point, it was it. She touched the money. There was no way around it. She lost all, chances to 1031 it. So if you are thinking about doing it, talk with your CPAs and accountants early on. Talk with an intermediary, start that conversation as soon as possible to get that stuff in the works to make sure that you do not miss it or do not mess up so you can avoid those capital gain taxes on the sale of a property.
And I'll add too, so just recently, my business partner and I completed a 1031 exchange, and we actually did it, it was fairly complicated because not only did we 1031 from one property to another, but we actually ended up buying two properties with the funds that were coming out of the one that we were selling. And there was also some shortfall, or they call it a boot, and other things that were involved. It's definitely a highly specialized field. And the other thing that I also want to make sure that people understand from what you were saying, Sean, is that an intermediary actually can't be your regular accountant either.
Correct.
So
Correct.
You definitely want to consult with your accountant. You want to go to them and ask, and they may have recommendations for intermediaries in your area, but you can't even use them as your intermediary. So you can't just go sell a property, have the money hit your accountant's escrow account or something, and then try to use that money on another property. They won't even allow that. Yep. So definitely consult with a CPA first and foremost if you're planning to do a 1031 exchange, and then look for an intermediary. And we ended up actually getting one. I think we did a bit of Google searching. I called a few different companies, interviewed with them, kind of discussed the deal with them, and then we ended up using one. And the cost difference is actually very significantly. We ended up going with an intermediary that was out of state, I believe in North Carolina or South Carolina, and we're in New York. And that's where the property was, in New York. But it actually worked out really well because was fairly inexpensive to do that with them. It was, like $700 or something like that, where some of the local companies were quoting us like $2,000-$3,000, which, it's not a huge expense, but it's not an insignificant one either if your goal is to try to save some money on taxes ultimately.
Yep.
And the other thing too, I think as you have it on your PowerPoint slide here, and you might want to touch on just some of the timelines and dates involved with the 1031 exchange. If you could just touch on that for a second.
Yeah. So these rules, may have changed. Again, you have to check with your intermediaries, check with the CPAs. Last time I was working with them was, you have 45 days to identify a property to buy after the sale. So, which means, okay, you set up all of the original paperwork before you sell a property. Selling the property now you have 45 days to be able to identify. You have to specifically identify. It can be more than one, but you have to identify a property that you are going to be closing on. And then you have to close on that property within 180 days after you sold it. If not, it's done, out the door, capital gains, everything's taxable at that point. The one other piece too that gets missed very, very often is mortgages. So when you have a mortgage or debt, a lien, whatever, on a rental property, and you 1031 it into a new property, you must take out or mortgage at least the amount that you had previously mortgaged. And I have seen this firsthand with an investor. They had sold a property. They had a mortgage of their $40,000. It wasn't a large property, so he had the cash liquid. He's like, "Yep, I'm buying it cash. Don't worry about it." And I said, No. I said, you need to be able to take a mortgage out on that property of at least the same amount. Because if you don't, the IRS assumes that you don't have a mortgage anymore, which basically means is like a cancellation of debt. And now that you don't have that debt anymore, they're saying, okay, well, you don't owe us. You don't have any more debt. Boom, that's all income. Mm-hmm. So then you would be taxed on, in that case, $40,000, in taxes. So again, talk with your accountant, CPAs, talk with your intermediaries there, but it's a great tool that can be definitely used to save some taxes. Cash out refinance. So this, is right on my alley when it comes to what, I have personally done. I know you have, Vitaly, many, many, many times. And this has been one of the best, resources for us as a, real estate investor. Using that BRRRR method, buying it, renovating it, rehabbing it, renting it out, refinancing it, and repeating. Well, during that refinance process, the value of the property may be more than what you actually are all in it for. And you actually are going to pull some of the equity out when the bank cuts the check at the end of the day. Yep. When you do that, that money you get is tax-free, technically, because it's a loan. It's debt that you obviously owe back to the bank. So you could be taking out money of equity out of a property and then basically putting that in your pocket and essentially in a tax-free fashion, which has been great. I have heard some things out there that the IRS might, put some stipulations of charging like a refinance fee. Some banks have their own fees, and obviously you pay mortgage tax, and at least in New York State, you have to, by each county, whatever taxes you take out on the mortgage, you have to be subject to those at closing. But there may be something down the line where the IRS says, well, hey, if you refinance, you're going to pay 1% to the IRS, basically, in your refinance. So nothing set in stone today. Tax laws change every single day. So just something to kind of keep in mind.
The other cool thing about cash out refis, especially if you took advantage of them a couple of years ago, where when the interest rates were really low, even a year ago. So we're recording this in March of 2023. A year ago, interest rates, even for non-owner occupied multifamily properties on refi loans, were like, some of them you could even get into the 3% range, which is insane, right? So like if you took advantage of it then and you took the money out, you had some equity in the property, you refied it out, and you then had that money and you're paying the interest. Yes, the interest is still paid to the bank. It's still a cost, but it is currently below inflation, and it has been for the last couple of years.
Yep.
And, if the loan is at the very least locked in for the next 5 years, so in commercial loans, we do, it's 5-year arms where they reset after 5 years, but the interest rate is locked in for 5 years. So you're basically getting free money from the bank that you don't have to pay taxes on, and you're tapping into the equity of your property that you can then use on other real estate, use on other investments, and double and triple that money as you go. So, obviously things have changed a little bit with interest rates. They are much higher now, but even now, they do fluctuate here and there, and you can get something in the 5%, 5.6, 5.75% range. Sometimes that may still be worthwhile to do, especially if you're not paying any of those taxes, you're not selling the property, you're not getting rid of the asset. The asset is still able to cover the costs, the additional costs that will be put on with the new mortgage, but you can reuse that money and put it to good use and make more money on it, buy the real estate with it. So exactly. I like that tool a lot, and I think that's a great tidbit for people to use.
Yep. So the next piece here is installment sales, which is just another name for seller financing. This was another great way for people to get into real estate that maybe don't have the cash enough for a down payment. Maybe you have a seller that is willing to hold the mortgage. In this case, basically meaning instead of you going to a bank to take the money out to pay them, they become the bank. So you take title ownership of the property, they become the bank, and then you pay them essentially. Instead of paying the bank every month, you would pay the owner the mortgage, the principal and interest that would be owed to them. Obviously, you have to work out terms, interest rates, all of that stuff. Now, on the flip side of it, if you're a seller, it's a great tool as well to be able to, again, not avoid, but delay capital gain taxes and depreciation recapture taxes down the road. So if you have a property, you're like, you know what, I'm done. I don't want to, be involved with the management anymore, but I definitely want consistent cash flow coming in every single day. Well, seller financing, installment sale would be the perfect opportunity for you. If you find somebody that's going to willing to buy it, they take over all of the management, they take over the leasing, the fixing it up, dealing with the entire property. Now you hold the mortgage every single month. They write you a check, just as if you were basically getting cash flow on the property. So portion of that would go to the principal, portion of that would go to interest. The good thing about that is now instead of selling the property for $200,000, if you had a deal where it was over 25 years amortized at 5%, you might make $280,000, $300,000 over the course of 25 years because you're getting interest on that money. And then again, work with your accountants because there are a specific formula. There's a couple, specific tax forms that need to be filled out if you are doing an installment sale. And, what would be taxable each year would depend on how much they pay, how much the gross profit was of when you sold the property, so on and so forth. But ultimately, you're going to be significantly delaying out taxes over many, many years. So you're not getting hit with that $30,000, $40,000 tax bill on the sale of one property in 1 year. Installment sales are great for that tool. The other one here is step-up basis. So as of today, which could change every single day, there's basically a rule out there that says when you pass away and whoever inherits your property gets that value, gets their basis at the cost, at the value of whatever the property is at that time. So for example, if I bought a property for $100,000 today, 40 years down the road, 60 years down the road, the property is worth $500,000. I turn around and sell it. I probably have depreciated everything. I'm going to get whacked in taxes because I'm going to pay capital gain. I'm going to pay depreciation recapture. I'm going to pay all of that on $500,000. Now, if I just passed away, let's say, and I gave that property and inherited it to my son inherited the property. The value of the property at the time was $500,000. He gets that value at that basis, $500,000. He turns around and sells it tomorrow, the next day, for $500,000. His basis is $500,000. His sale is $500,000. Tax-free gain. So basically, he got to step up to whatever the value was at that time. Great tool for wealth building and for future generational wealth. In a perfect world, if you could buy a bunch of real estate, 1031 everything up until it's continuing to grow, and then you pass it off to your kids, and then they sold it, and you've basically avoided taxes your entire life owning real estate.
Yeah. Let me ask you this. So this is more of a clairvoyance type of question. I'm sure you don't have a crystal ball on this, but how likely is it that at some point in the near future, this will be eliminated by our government? And just prefacing this with, I've heard many rumors and sort of a lot of suggested bills and laws that have been floated around by different administrations, different senators. What's your take on it? What do you think? Will this last the next few decades, or you think that's going to go away at some point?
I think I think it'll be very difficult for it to go away. There's a lot of small mom and pop people that I think it would be very disadvantaged to if it did go away. Most of the rental property owners in the United States are really not those big investment companies.
Right.
They're actually people who live in an owner-occupied two-family, or they just own the single house and then they have one other property. That's most of the, makeup of real estate investors out there. And it would be a substantial disadvantage to people if it did. Obviously, I could be completely wrong. There are already discussions about it in the works today. The current administration is thinking about getting rid of it. Now, who's to say that the next administration comes in and doesn't even talk about it and it's fine for the next, 4 to 8 years after that? We really don't know. All we do know is as of today, this is where it stands. And, maybe they do something where if it does switch, they grandfather in people. I've seen that done in the tax code where it's all the time. Oh, if you bought a property before this date, then these rules apply. After this date, these rules apply. So, you got to just, again, educate yourself, talk with your accountants, see, what they're hearing on their side too. And, really make your best judgment, moving forward, investing wise.
Makes sense.
So the other couple of pieces here, interest expense. So, when you take out a mortgage on a property and the repayment of debt principal is obviously not a tax write-off. That's you paying off debt. So you do not get to write that off, but you do get to write off the interest that you accrue on those. Usually you'll get a 1098 from the lender. Again, that's majority bulk of your large expense that you're going to be able to write off on a rental property is that interest that you pay. But in theory, right, the tenants are the ones paying the mortgage, paying all of that stuff. So you get the advantage to write it off while still collecting the benefits of the rental income. And then also, I just wanted to touch bases, on 1099 and contractors. So if you are a real estate investor, most of the time, we have handyman, we have a plumber, an electrician, whatever may have you, that are doing work for us on the property. In these cases, these people need to be 1099. And if they were given over $600 over the course of a year, I just left on there some of the information that you need. That's very important to know. If you want to be able to claim that expense, you do need to 1099 them. Now, if you did not 1099 them, but you put the expense on your tax return, and the IRS never came knocking, so be it. Maybe you got away with it. If the IRS ever comes in and says, hey, Sean, let me see where you paid John Doe for, that work on that, prop 123 Main Street for $1,000, and I hand them an invoice and they say, okay, but where's your 1099? You paid them cash, you paid them whatever. Then if you can't provide that, then they could say, well, we're going to disallow that expense and essentially gross up your income by that much. And that's what you would be subject to pay additional taxes on.
Right.
So just important to know.
What are the chances, Sean, that, obviously some other thing that was in the news recently was the proposed increase of the number of agents in the IRS that would be doing audits and things like that. Yeah. We're talking about a lot of the people that may be watching or listening to this are, small multifamily investors. Like, what are the odds that people like that get audited for these types of issues versus, some bigger companies or bigger investors that own hundreds of units, for example? Yeah. So this is just my personal take on it. Again, every CPA is going to have a different opinion on it. They did with one of the other recent bills that came out probably about a year ago now, they had, in there that was 80,000 new IRS agents were going to be hired to essentially generate audits, which in turn is going to generate more income for the IRS and the government to do the things that they proposed in the bill. That's point blank period how it was supposed to work. I do know that they haven't officially went through with the hiring process of the IRS agents as of March 2023. And reason being is because a couple of the other government parties are fighting it. They don't want to do it. They feel like it's going to hurt the
middle class, people, if they're the ones getting audited and we're the ones that are going to have to, give back most of our tax money, substantially hurt them. So my full take on it is, one, they would have to find 80,000 qualified, educated auditors to be able to go out there and actually do these things. Now, you and I both know we have many of businesses that we're running here. How difficult is it for us to find work nowadays? We can't even find, a plumber to fix us a leaky sink, let alone someone who's qualified and understands the tax code and be able to, work through audits on, multiple different, scenarios and stuff. It'd be very difficult for me. So what I think would happen is they would hire these agents over the next couple of years. By the time they're actually trained and actually in the force, you're probably looking at, 2026, 2027 before like anything ever was to come about it. Mm-hmm. So what I tell my clients now is I say, look, the past is the past. 2022, we can't change it. 2021, we can't change it. What we can do is, I think by the time they do start knocking, if they do, they're going to start looking at 2023, 2024, 2025. They're only going to be able to go back a couple of years. But on board, let me make sure that we're up to date now. It's important to know that our accounting is good now, that our books are in order now, that we're 1099ing our contractors now, that we're doing everything right now, because if they do end up come knocking, I think you'll be prepared. We can't change what we've done in the past. It is what it is, but we can change what we're going to do moving forward. So that's kind of my advice on what I tell my clients on what can happen here in the future with that. And then lastly here, so again, as a CPA and accountant, at least in my sake, I don't need to see every single receipt that you have on your property. I just really need good, clean books. Again, every accountant would be different. Every CPA would be different. Keep good records, work with your accountant, and, make sure that you're doing good tax planning, because having those discussions throughout the year could, save you tens of hundreds of thousands of dollars. I've seen it, literally have seen it firsthand. If a client didn't call me, in June and say, hey, I'm selling my property, what do I got to do? I'm like, oh, well, hey, John, you're going to get slammed here. We got to put some money aside. And then I've been on the other side where it's December rolls around, January rolls around, and then they're like, oh yeah, I sold the property, but I bought a vacation house out in Florida for, the amount I took. And I'm like, you didn't call me. You didn't have that discussion. Now we're sitting here. Now we owe, $50,000 and they don't have the money to pay it. Mm-hmm. So make sure you're having those discussions as early as possible, especially the big key factors that could really implement or affect your tax return overall. So this is kind of a little bit more just like, hey, like what can I write off type stuff. I get this question all the time. I don't have a business. I can't have write-offs. And that is one of the largest misconceptions as a tax professional that I see in my career. You do not need an LLC. You do not need an S Corp. You don't need a corporation. You don't need any of that stuff to be able to have write-offs. If you are generating income, selling lemonade out in front of your house, or owning a rental property, you can have as many write-offs as you deem reasonable that would help you generate that income. Whatever it takes for you to do to sell that cup of lemonade, whatever it takes you to earn that month's rent, you can use that expense as a write-off. So that's very important for people to understand, at least from a tax perspective. Now, as a real estate investor, what can I write off? So obviously insurance, property taxes, water, sewer, HOAs, mortgage interest. If you're paying commissions, maybe you have a leasing agent helping you out. Maybe you have a realtor that helps you, rent out the properties. Education and training. Bigger Pockets has a handful of books out there. They have a handful of podcasts. If you're paying this stuff to try to learn to buy another rental property, you can use those expenses as a write-off. You are trying to educate yourself to generate more income. Obviously, marketing and advertising, mileage rate. If you have to go to the bank and cash a check a tenant gave to you, if you have to run to Home Depot and run back to pick up a toilet because it broke, those miles that you're driving could be used as an expense to offset your rental income. Obviously, pens, papers, if you're buying small supplies, materials and stuff, if you buy a receipt book and you give it to your tenants to, give them a receipt on the rent paid, like those things, obviously you can write off. Meals. So, if you go out to lunch with your real estate agent, if you go out to lunch with your attorney, if you go out to lunch with a client, maybe you go out to lunch with a seller that is thinking about selling their property and you just want to buy them a cup of coffee, those things you can write off. In 2022, they're allowing 100% of those meals to be written off. In the past, in 2021, it was 100% as well too. But moving forward in 2023, it'll go back to 50%. So if you bought a cup of coffee, it costs you $2. You can only write off $1 on your tax return. Again, you don't need to know that as an investor. You just need to know that difference is out there, and your CPA should be able to adjust those things on your tax return for you. Fees, license, membership to the MLS system, which is our multiple listing system we use here in the Albany area as a real estate agent. Those things, obviously you can write off any bank fees, subscriptions, things like that. Software is business tools. If you buy a laptop because you need to do more research, if you buy a piece of equipment, if you're using your phone to make phone calls to your tenants, to your attorney, to your contractor, well, take a reasonable percentage of your phone bill. If your phone bill is $100 a month and you probably use it 50% of the time for real estate, well, 50% of your phone bill can be a write-off. Significant travel, if you really are thinking about buying a rental property in a specific location. We live in New York here. If I wanted to travel to Florida to really look at some property, make sure you have good documentation down. But, you could be able to essentially write off that entire trip. Again, work with your CPA on the exact amounts and, what would be actually being able to a write off or not. And then again, I always get the question like, well, Sean, how do I keep track of this stuff? I got a million receipts here. They're in my glove compartment. They're in my house in a folder. The best way to do it is to really open up a single bank account and flow everything through that one bank account. Then at any given point, if you need to pull a receipt or you need to have your accountant or your CPA work through things, they have all of their information in one bank account. Those bank accounts can be linked to QuickBooks nowadays. They can be linked to many different things to be able to extract the data out that you need to generate the expense list that you need to create to basically give to your CPA.
And one caveat I just want to add with that advice, I think that's really good advice. If you're buying things in separate LLCs and you have business partners in those LLCs, yep, I would suggest, and I'm sure you would agree, to have separate bank accounts for each one of those entities, because technically they are all their own, not only tax entities, but also legal entities. So you've got to look at them as its own, like it's a person, you know what I mean? For the purposes of both liability separation and tax planning and tax strategies. And I think what Sean is saying here is if you own things in your own name, if you own rental properties in your own name, then yes, you should have a separate bank account for your business, for your rental properties. But if you have multiple different LLCs, as I do, and as Sean, as you do, you want to separate not only those LLCs, but also separate your bank accounts for both the tax purposes and liability purposes. Would you agree?
I would agree 100%. And just to kind of piggyback off that, the tax forms are designed to have every rental property building separated on your tax return. So the best way to do that is, and sometimes it might be a little bit more costly, and sometimes it might be a little bit more accounting work, but the best way to make sure that it's done correctly and to make sure that you're not missing anything would be to maybe even have a separate bank account for every property. So if you have one LLC, but you have 5 properties in that LLC, you can open up 5 business accounts. Property A business account, property B business account. Then that way, flow all of the income and expenses through in each individual properties. Then at the end of the year, you have your profit and loss already done for each individual property that you could give to your accountant. And it just simplifies everything rather than, your personal credit card over here, my sister's credit card over there, my personal bank over here, my piggy bank for my cash, so on and so forth. It just simplifies everything if you have it, structured that way. So the other piece here was, I know you briefly asked me about this earlier. Hey, can I use my loss on my rental property to offset my W-2 income? The short answer is yes, if you meet basically one of the two criteria I had noted here. If you are a real estate professional, or if you make less than $75,000 a year, single, $150,000 married, I believe. And then there's some phase out rules too. So as you start to make so much more money, the limitations kind of trickle down on how much you can actually offset against your personal income. So what distinguishes real estate professional status? You would have to have performed 750 hours in the year. And to be clear, you do not need to be a real estate agent in order to meet this status. And 750 hours are not just, it has to be specifically hours working on your rental property, whether you're doing the accounting, whether you're swinging the hammer, whether you're picking up the rent. There needs to be like specific documented hours technically in the IRS to meet the 750 hours a year. More than 50% of your personal services you perform in all businesses must be performed in a real estate that you materially participate in. And, the day-to-day operations, you need to be doing the accounting, the maintenance, the property management, so on and so forth. The biggest thing that I see with my clients is that they have a property in Texas and they live in New York. And they live in New York and they want to say, well, I showed a $20,000 loss on my rental property out in Texas. It's the only one I own. And I want to make sure that I can write that off against my W-2 income. Well, I'm like, to be quite frank, it's going to be very difficult for us to prove to the IRS that you are materially participating in this rental property if you aren't near, obviously, the location. Right. Two, you're probably hiring a property management company for you at that point, and they're providing you statements to you. So at that point, I say to them, look, it'd be very difficult for us to be able to justify that, in that terms. Now, if someone like you and I, who we are very close to all of our rental properties, we can check in on things. We are right in the area. We property manage our own properties. We could most reasonably justify the 750 hours without a problem. Again, probably sound like a broken record, but make sure you're talking with your accountants on claiming this status if it's possible, if it's reasonable or not. And but when I first got into real estate, I was not making over the $75,000. I had a single rental property, and I was able to take my $10,000 losses on my duplex and offset that income. And I got a lot of big refunds back from that because I basically overpaid them through my W-2 income. So it's definitely real estate can definitely have some major tax advantages for sure in that aspect. So this was just a little sheet that I had, kind of found, and I thought it was pretty interesting. Basically, in this case, so what this is kind of showing you here is the cash flow that you're getting on a property, but what is the actual true expenses that you're paying on your property. So this is if someone just owned a traditional rental property, we'll call it a single family or two family house. You have your rental income, you have all of your just general operating expenses. And then what is this phantom expenses? So basically what this is saying is these are things that are not a true cash out the door expense, but you can still claim the expense on your tax return. So depreciation, in that case, you get to depreciate, as we talked about before, 27 and a half years. Cash didn't go out the door when you did that for depreciation, but you can still claim that as a write-off on your tax return. They do put the home office deduction in here, which I'm not crazy for as taking on a rental property. But the other one here is the phone and internet. So everyone's got a phone bill regardless. You're going to have a phone expense that you can write off against your rental property. So they're including that as a phantom expense because whether you had a rental property or not, you're most likely going to have a phone bill.
Right. And
So
just for everyone who's sort of listening to this and unable to see the screen, what Sean is showing is a chart basically where at the top you have $30,000 of rental income, and then you have various operating expenses, cleaning and maintenance, insurance, professional fees, management fees, mortgage interest, repairs, taxes, utilities, all those different costs of running a rental property. All of those costs are obviously coming off the top income, the gross rental income of $30,000. But then there's also a section which Sean is referring to as phantom expenses, where you have those two or three different expenses that didn't actually come out of your pocket. But at the end, you have, as he'll touch on, cash flow of a certain amount, but actual reported cash flow on Schedule E is actually a negative, which is a loss, which means you didn't have to pay any taxes on it, right?
Exactly. So in this specific scenario, you were able to put $5,500 in your pocket, but the IRS viewed it as you have a loss of $5,600 in a loss. So, I mean, that's $11,000 swing right there. Absolutely. In taxable income that you've essentially avoided. And, that's just one minor minute example of real estate investing from a tax perspective. But this is why I love it. This is why we're in it. So,
absolutely. Yeah. And taxes are such a big part of investing in real estate, planning for them, making sure that you're taking advantage of it, because it's such an advantaged class of investment. Or investments in the United States, at least right now, which is why, one of the big reasons, one of the four main drivers of why real estate investing is, in our opinion, one of the best ways for someone to start in middle class and maybe make it to the upper class.
Yep. So then again, I just added this little article in here for anybody who has access to it. It's just strictly educational use. Please don't advise anything on it. I just thought it touched on a lot of good points in there. Just from a simple buy and hold investor who's really looking to get involved into real estate. Again, work with your CPAs, work with your accountants, make sure you're kind of looking over everything and having those discussions as early as possible. And I hope some of the information in here, was helpful for whether you're just starting out or maybe a seasoned investor might have learned something that their previous accountant may not have touched on. So.
Yeah, and what I'll do is I'll take that link and I'll put it in the description of this video on YouTube and in the show notes on any podcast platforms that you guys are listening to this on. So that if you wanted to click on it, follow it, and check it out, you can do it there.
Great.
Awesome. Well, Sean, this is really, really useful and interesting information. I think, people need to go back and rewatch this because obviously we shared a lot here. And, if they have any questions, if you guys have questions, and you're watching this on YouTube or other platforms that allow you to put comments down or comment at the bottom, go ahead and drop those comments, and I'll try to answer them, and I'll tap Sean to answer anything that's more technical if you guys do have those questions. But now I do want to transition to our next segment of the show, which is called Overrated, Underrated, and I want to ask Sean one particular question with regard to tax planning that I want to get his opinion on. So guys, I'm talking with Sean Daley, a CPA and a local real estate investor in my local area in upstate New York. And we've been talking on this podcast all about tax planning strategies, real estate investing, and advantages that real estate investors can take from real estate with regard to tax planning. But I just want to ask you this question, and sort of from your personal experience and the clients that you see and people that you talk to, how seriously do people actually take tax planning in their day-to-day lives when it comes to real estate investing? Is it an overrated thing where, so many people are actually doing it, or is it underrated where people are kind of dropping the ball when they're coming to you and maybe throwing a bunch of receipts on your desk and saying, "Hey, help me," and it's April 10th.
Exactly. Yeah. So definitely for the most part, it is highly, highly underrated. I see it across every single one of my clients, every single year. The tax planning could always be better, could always be fine-tuned, and could always help, be more of have more communication between you and your tax preparer. So I work with a lot of different clients here in the Albany or in the upstate New York area, in addition to many over the world. But I have seen clients come in on the last day, dropping off things, and then I've had clients where we're talking throughout the year. To the clients that I'm communicating with throughout the year, whether it's a 5-second phone call, whether it's a cup of coffee, whether it's dinner, I have seen substantial tax benefits from them by having these conversations, because we are talking about what they're doing in their lives and what they actually plan on doing moving forward. So, you really have to build the story as being a tax preparer. My goal is to really build a story with every client and project where their story is going into the future and how we can tax, or how we can add in any tax value or obligations or whatever the case may be into that, story for that person. So the more information I have, the more relationships I can build, the more time I can talk with that person, the more story we can build and the more plot we can put behind, and the more decisions that we can make moving forward. So it's definitely underrated, and it's a tough thing to tackle. I know I talk with a lot of clients, and I do it for a living, and it's one of those things that they just keep putting behind X. I have to do my taxes. But you need to tackle it head on, and you need to have that conversation, and you need to work with a good CPA that understands you, your story, and where you see yourself going in the future. And I think if you can really start those conversations now, and hey, it's late March of 2023.
Yeah.
2022, it is what it is. Work your best through it. But what you can do is you can start planning for 2023 now. And that's what I'm trying to teach to my clients today, is like they drop off a box full of envelopes and sticky notes and napkins with expenses on them. And I'm like, look, we're just going to get through this year. It's March 25th. But hey, this is how we're going to tackle 2023. And this is what we're going to do moving forward. And I need you to hold yourself responsible, and I will hold you responsible just as well too. So when it comes tax time, we can have a conversation, and actually educate ourselves and actually be able to take advantage of some of these things that we may have missed the past couple of years. So, it's definitely underrated, and it's definitely something that needs to be spoken about more often. And people just need to just tackle it head on and have those conversations as soon as possible.
Agreed. I love the advice, man. Yeah, I agree with you 100%. All right, let's move on to the second to last segment of our show called In the News. And there's one particular piece of news making the rounds right now that's relevant to real estate investors and just the public in general, really, that I think is important to tackle before we wrap up. All right, Sean. So I'm here with Sean Daley, a CPA and a local real estate investor in our upstate New York State market. And we're talking all about real estate investing strategies and tax strategies. And one of the things that I want to talk to you about in this particular In the News segment of this podcast is something that has been making the news in, as far as taxes are concerned with regard to the current administration. And I just want to put up an article on the screen and share it with you guys so that you could see this is more of a press release rather than an article, but it's talking about the different tax implications and changes in the Biden administration budget proposal. So there are a few different things on here, but I think as relevant to us in our discussion, Sean, I think you wanted to point out a couple of things. I personally am pretty afraid of what these changes are being suggested, and kind of not necessarily very happy about them, but I wanted to get your take on it and what you think of it.
Yeah, so I think the first and foremost, the most important thing to realize is that no matter what happens, the tax law is going to continuously change. It's going to continue to change every single year, every single administration. And at that point, that really goes back to a lot of the topics we talked about earlier, is you really need to be able to have these communications with your CPA throughout the year to prepare yourself for these changes. And if something is going to substantially impact you as a real estate investor, as a business owner, as a person just with a W-2, you really need to know what is going to be happening in the future. and having those discussions and making sure you're putting yourself in front of a reliable, trusted CPA, I think is the most important thing. So a couple of the things that the current administration is thinking about basically changing here in the future is increasing the rate for the long-term capital gain rate. So,
Exactly.
I mean, that right there is from a real estate investor's perspective is massive, massive news that would change all the way that people invest. Would it make sense to even hold these properties for as long as we do if they're going to increase the long-term capital gain rates to, 39%? In here, they're saying over $1 million, but, the value of real estate only continues to go up most of the time every single year. So, a $600,000-$700,000 property might be worth $1 million in, 5, 6, 10 years down the road.
Absolutely.
So, you really need to make sure that, if those are the decisions you were thinking about, you can't be relying on where the law and the regulations are today. You really kind of got to think about, okay, well, if this does change, what are my outs? What are ways that I can avoid it down the road? What are some different things that I can do? And I believe another one in here too is the step-up basis. I thought I had saw down below, or not step-up basis, 1031 exchange. Other changes include carrying interest loophole ending, the like-kind exchange benefit that allows the real estate investors to defer. So, I mean, that like-kind exchange is a massive, massive tool that real estate investors use. And it's something that if that did go away, that would substantially change. It personally changed the way I, think about investing. Maybe I probably wouldn't buy the smaller, very small, minute multifamily. Maybe I might try to go for something a little bit bigger, knowing that I can't continue to scale up those smaller properties into big ones. So, things like that, I think is just, very important to really think about. And, continuing to have those conversations, with your accountants and CPAs to make sure that, you're ahead of the game, as these changes come down the road, and they're going to happen. I mean, the 2017 tax law that changed everything, that the way taxes were done. And, it really impacted a lot of people, mostly for the better. But, we have to be able to think about these things in the future. So.
Agreed. Yeah. And I think, as things change, obviously it's an ever revolving door in terms of administrations, politicians, who's in charge. So these things can ebb and flow and go back and forth. And obviously, I think in order for this to actually become law, President Biden needs to get, buy-in from both chambers of our legislature, of Congress. So as long as there's some backstop to it, which there is right now, I think these will be stayed off. But that doesn't mean that it can't change in the future, or other things, maybe the pendulum would swing the other way in the next election. And, you just never know. But I think it's important to, again, consult with your CPAs, keep an eye on the news, and plan accordingly, and try to strategize with your investments and your planning accordingly, according to what you're hearing and seeing.
Yeah, absolutely.
Cool. All right, Sean. So let's jump into the last segment of this show called Tip of the Week, where we're going to hear your tip for real estate investors and people watching this podcast. All right, Sean, we're here. We're at the end of the show. What tip would you suggest, or what tip do you have for people watching this podcast?
Yeah. So the biggest thing that I come across all of my clients is record keeping. Everybody struggles with it. I personally struggle with it too. It is not an easy task. It is a long, brutal task that nobody wants to do. And it really impacts the timing of when you can get your tax returns done. Yep. It really impacts you understanding your business inside and out, and really knowing how much money you're truly making on a rental property or your business. So the tip I would really give is to have a bank account specific to your business, or in this case, each individual rental property, and to flow all of the income and all of expenses in and out of that bank account. Yep. So I get the question all the time, but Sean, I need to replace a roof. and my bank account for my rental property only has $2,000 in it. The roof's going to cost me $10,000. I got to pay for it over here. And I say, no, you don't. I said, what you're going to do is you're going to take the $10,000 out of your savings, whatever, wherever the money's coming from. You're going to transfer it into your rental property bank account, and then you're going to pay for it out of that bank account.
Right.
Now we are going to treat, from a tax perspective, we're going to treat that money coming in as a contribution in, so no impact on your taxes. And then that money coming out is an expense that you'll be able to write off or depreciate. Now, if you do that for the entire year, and you are working with your accountant, you're working with your CPA, and you have every single bank statement, and everything's accounted for in there, money in, money out, you are done. You don't have to pull receipts from over here. I use my credit card over there. I borrowed cash from this person. Everything is in your bank account. You pull 12 months worth of bank statements. There's all of your activity.
Yep.
You could even take it a step further. You can link up your bank accounts directly to QuickBooks nowadays. You can have it automatically populate, right? Set it up some rules, automatically populate right into the categories. Your accounting could be done in a matter of minutes if everything is flowing through to one property or to one bank account, and then your record keeping doesn't need to be as crazy, And I've seen the IRS come in, and sometimes they ask for individual receipts, and sometimes they look at a bank statement and they'll say Home Depot, and it's like, okay, we know it was a Home Depot. We don't need to see the actual receipt that you got that day. You have a bank statement that shows it was from Home Depot. Yep. So, that's probably the biggest tip of the week, and tip of the year. We're going to call that one, because you have to do it for the entire year. And again, work with your accountant CPAs, and make sure that that's a good structure that would be able to give to them when it comes tax time, so that they can make sure that they get you done quickly, efficiently, and also as best as possible. So.
Awesome, man. That's great. And I really appreciate you joining me on this podcast. And one last question for you is
Sure.
If people wanted to connect with you, where can they find you? How can they reach you?
Yeah, I would say, honestly, the best way is really through email, yourdailyyinvestor@gmail.com. You can shoot me an email. I'd be happy to respond. I got about 15 more days of tax season. So about 15, 16. And anytime after that, if I don't get to you back to you right away, I'll definitely make sure I set some time aside to respond to some people. You can also check me out on Instagram, Your Daily Investor, as well. I'm just starting to post. I'm not too big in the whole social media presence. So, continuing to work and stuff, and also raise a family and things like that have been taking up a lot of my time, and buying more real estate. So, but yeah, I really appreciate you having me on here, Vitaly. And, thanks for everything. And I hope this was helpful to a lot of people. And if you have any questions, feel free to reach out.
Yeah, it definitely was. Thanks again, man. I really appreciate it. And we'll be talking soon.
Awesome. Thanks, V. I'll see you later.
All right, have a good one. Bye.